What if I told you there is one technical analysis tool used by professional traders, hedge funds, and institutional investors all over the world that most retail traders use completely wrong? It's called Fibonacci Retracement. And today I'm going to show you exactly how to use it the right way, with real chart examples, real entry points, and a complete step-by-step system you can start using immediately. By the end of this video, you will never look at a chart the same way again. Before we get into how to use it, let's quickly understand what Fibonacci retracement actually is. In the 13th century, an Italian mathematician named Leonardo Fibonacci discovered a sequence of numbers that appears repeatedly throughout nature. Each number is the sum of the two before it. Divide any number in this sequence by the next, and you get approximately 0.618. These ratios appear in sunflowers, seashells, and DNA spirals. They also appear, with remarkable consistency, in financial markets. Why? Because markets are driven by human psychology, and human psychology follows predictable patterns, the same patterns found throughout nature. The key Fibonacci retracement levels traders use are 23.6%, shallow retracement, seen in very strong trends, 38.2%, moderate retracement, common in strong uptrends, 50%, psychological midpoint, not a Fibonacci number but widely respected, 61.8%, the golden ratio, the most important level in all of Fibonacci trading, 78.6%, last line of defense before trend reversal. This is where most traders go wrong immediately. They draw Fibonacci on random price moves, small bounces, minor pullbacks, insignificant swings. Here's the rule professional traders follow. Only draw Fibonacci on major swing points. A major swing high is a price peak clearly visible. A major swing low is a price valley that is clearly visible, lower than the candles on both sides, representing a significant turning point. In an uptrend, draw Fibonacci from the major swing low to the major swing high. This shows potential pullback levels. In a downtrend, draw Fibonacci from the major swing high to the major swing low. This shows where price might bounce before continuing lower. Common mistakes include drawing on time frames that are too small and moving levels to make them fit. Always use at least the 1-hour chart. Now let's talk about the most powerful concept in all of Fibonacci trading, the golden pocket. Professional traders focus almost exclusively on the area between 61.8% and 65% retracement. This is where price bounces with the highest consistency. Step 1. Identify a strong uptrend. Step 2. Draw Fibonacci from major low to high. Step 3. Wait for price to pull back. Step 4. Watch for a confluence factor. Step 5. Wait for bullish confirmation. Step 6. Enter the trade. Confluence is the secret weapon. A single Fibonacci level is interesting, but multiple factors make it a high probability trade. Look for support and resistance, moving averages like the 200 EMA, high volume at the level, or RSI being oversold. Let's look at NVIDIA in 2024. The stock pulled back from its swing high, landing exactly at the 61.8% level. In the 2022 S&P 500 bear market, every relief rally was sold at the 61.8% retracement. Fibonacci works in both directions. Risk management is key. Always place your stop loss below the 78.6% level, because breaking it invalidates the thesis. Never risk more than 1 or 2% of your account on a single setup. Fibonacci is not magic, but it's powerful. Practice this on historical charts first. Subscribe to Trade with Pradeep for more strategies. Drop a comment below with your questions, and I'll see you in the next video.